Thank you, Martin. And as Minister at St Cuthbert's, it's a great privilege and pleasure to welcome you all to this relaunch of OASIS. And Martin will say a bit more about OASIS towards the end of the meeting for this lunchtime gathering. I just heard that Ben has the curry, but we've all been encouraged to bring our own lunch with us. So I hope you've got something to nibble at during this meeting. However, for me, it's a great honor and privilege to welcome as our first visiting speaker online, Dr. Ed Trevillion. I've got a summary of his very impressive CV. Ed is currently Honorary President of the Real Estate Investment and Finance, Honorary Professor of Real Estate Investment and Finance at Heriot-Watt University. And he's had wide experience of both academic and market-based research and has held such posts as Head of Real Estate Research and Strategy at Scottish Widows Investment Partnership and Head of Property Research for GVA. His PhD was from Heriot-Watt University and was for a thesis on the use of complexity theory to model property market behavior. And he continues to be interested in this type of research. I must say, for me, just jumping ahead a bit in his CV, I was fascinated by his engagement post-Chernobyl during the time in which he worked for UKAEA, United Kingdom Atomic and Energy. I missed the A, but that's not
authority.
Authority. There has to be a bit of authority in an agency like that, I'm sure. Dounreay. But then in September 1986, he was part of the UKAEA team to go into old USSR during the time of the Cold War. And for me, that's a great link, having guarded the Berlin Wall during the Cold War and, being aware of all that was going on. And then he went into USSR following the Chernobyl disaster. So we couldn't have hoped for a better first speaker for our OASIS relaunch. And there's so much in there that he only has 20 minutes, so I better shut up to allow him his full time. But anyway, Ed, lovely to welcome you, and over to you.
Okay, well, welcome everybody. Martin, if you put the first slide up.
Everybody's welcome on Spotify.
Right, thanks, yeah. Okay, let me start with, Martin asked me to give me, oh, hang on. I've got all sorts of things going wrong here. Thanks. I've got children at home, and I've got all sorts of things going on here. So could you put the first slide up, Martin? I seem to have lost it.
We seem to have it, I think.
Well, I'll carry on talking. I'll give a bit of background to me while you're looking for that slide. I originally trained as a chemist, and I did a degree and a PhD in chemistry. And that PhD, that was the first PhD. Sounds a bit grand, but it was the first PhD. And I looked at physical chemistry of liquid sodium. And as a result of that, and the work that I did there with liquid sodium, when I finished the PhD, I moved up to Dounreay, and I worked on the prototype fast reactor because that's cooled by liquid sodium. And I spent some time there, and I worked on the actual chemistry team on the reactor for a while, and then I led a small research team doing work in support of the reactor. And it was during that time, in September 1986, that I was asked to, because it was about reactor safety, to go on the first UK team into the Soviet Union after Chernobyl, and that was September 1986, and that was really a fascinating time. I was there for about 2.5 weeks and traveled all over the Soviet Union. I went to Shevchenko down on the Caspian Sea, managed to swim in the Caspian Sea. I went to what is now Ekaterinburg, where they had a reactor at Ekaterinburg. I went to a place called Obninsk, where the prototype RMBK reactor, the Chernobyl reactor, was. And that's really quite an interesting place. It was that area in, I'm old enough to remember this just, It was in that area where Gary Powers was shot down in his U-2 plane or whatever it was, trying to take photographs of Rob Nimtz. So I was there during that visit. Went down to a place called Kaluga, which is southwest of Moscow. And then I went a fair way down the Kiev road towards Ukraine. And in terms of radiation and stuff like that, it was getting quite hotter and hotter. And we decided that it wasn't wise to go too far down that road. So we went back up to Moscow. And that was a fascinating time. It was a period of change in the Soviet Union where Gorbachev had taken over and things were easing quite a lot. And was an interesting period of change, which was worth observing. And we traveled into the consulate in Moscow on a number of occasions. It's quite interesting. They used to say it's right directly opposite the Kremlin. I'm just going off on a wee bit because it's quite a fascinating time. And of course, they flew a Union flag over this building, and it was directly opposite the Kremlin. And they used to say that during the war, the first thing that Stalin woke up to, because his apartment was on the top of the Kremlin, the first thing he saw when he looked out of the window was the Union flag. And they eventually, which I always found quite interesting. But anyway, I stayed at the UKAEA in Dounreay for a wee while. And then in the early 90s, they decided to run down the program there. And they were looking for scientists to manage the rundown as opposed to financial people. And I was dragged out of chemistry, kicking and screaming, into the corporate team and helped manage the rundown at Dounreay. I was sent off to the London Business School, and that was the really big change where I started to do other things. But I got fed up with it. I didn't want to work in a place that was dying. And in '94, by that time, I'd got used to, asset management and thinking about how we were going to use the buildings and what we're going to do with the buildings. And in '94, I got the opportunity to do an estate management course at Heriot-Watt University. And as I said, I was pretty fed up with Dounreay at that time because it was a dying site. And so I went off to Heriot-Watt. I did a conversion course there in estate management. And then at the end of that, I was asked if I fancied a research associateship, which I did. And I did a PhD there in complexity theory and using systems theory to look at commercial markets. And that's the background to all of this work on irrational markets, because it's about behavior. So I'm going to start with the next slide, if I can, Martin. So this talk is really about behavior in the property market. It questions whether the market is irrational. It talks about irrational exuberance in that connection about behavior. And I've got some slides here on how behavior impacts on pricing. Now, I've done this lecture at Glasgow Uni, but it took an hour and a quarter. And what I've done for this, so forgive me, what I've done for this chat is reduce that to about 20 minutes. So there are some serious gaps in there, which we might be able to fill during the questions or whatever, but it is quite truncated from the longer version. So if I take the next slide, please, Martin, can I? So, I say there is rational behavior of markets is a non sequitur, right? If that, no, can I go back, Martin? No, that's it, stay there. In classical economics and classical markets, we talk about equilibrium theory, and all of our models, generally speaking, about, where we consider that the market behaves in a rational sort of way, that equilibrium theory in these models assumes that actors in the market behave in a rational way, that they're aided by perfect knowledge, that they're in pursuit of really clearly defined goals and objectives, and they maximize utility as per a supply-demand curve or whatever. that if you think about normal behavior and average behavior, that's not the way that normal people would recognize as corresponding to reality. We're not, we're not that clever. And it's interesting, I say there, that while financial markets are among those where expectations play an important part in the calculations of participants, it's actually precisely in these markets that rational behavior is notable by its absence. And that's the starting point for all of this work. So if I take the next slide, Martin. What I've done is applied this to, and Stuart will recognize this very well, we produced that book, Property Boom and Banking Bust, and we used this slide in that book. And what I've done to exhibit where property markets were behaving irrationally, I've used this slide as one, as the prime slide. And what I've done here is plot on the y-axis capital and rental value growth over that period from 1975 to about 2014. And the solid line there is capital value growth in property markets. And this is for the whole of the UK. It's an average across the UK. And the dashed line there is rental value growth. Now I've indexed both of those graphs back to 100 in 1975. Now, for the most part of that, it does what you'd expect. That rental value growth kind of mirrors capital growth, or rather the other way around, capital growth mirrors rental value growth. And if you think about how we understand capital values and capital growth, capital value is, fundamentally based on the current value of future cash flows. So you can do a DCF, discounted cash flow model, and you add in your rent, and when you discount all of that back, it should relate to value. That's how we value things in investment markets. So you would expect that capital value pretty much mirrors rental value growth. But you can see at the period in the run-up from about 2002, in the run-up to the global financial crisis, capital values just took off, right? They weren't behaving how you would expect them to behave in a rational market. And what was happening there was that people were piling money into, and I'll explain this in the next slide as well, were piling money into property markets, which were not reflecting the value of property based on a discounted cash flow assessment. So you've got that huge discrepancy between capital value growth and rental value growth, which persisted well past the end of the global financial crisis. Now, if I could get the next slide, Martin, I'm looking carefully at time here. Can we get the next slide? Yeah, great. Now, what I'm trying to explain some of this, and if you look at this graph, which plots yield on the y-axis against time, and the solid line represents initial yield. Again, it's an average across the UK property markets. The solid line represents initial yield, average initial yield in markets. The dashed line represents the yield on 10-year gilts. And in property, we use the 10-year gilt as the risk-free rate. And we use 10-year gilts rather than treasury bills because they kind of represent the average length of leases in the market. Now, in simple terms, the risk premium is the difference between the initial yield and the risk-free rate. And that's what that lighter line is doing. It's showing the yield gap between those two. What you'll see on that slide is that there are other adjustments you need to make. You need to add in rental value growth to that. So I've got risk premium equals initial yield minus the risk-free rate, but then you've got a growth through an allowance for rental growth and depreciation. Now, if you look at that slide and you look what was happening around 2006, 2005, 2006, where the initial yield dipped below the gilt yield, the risk-free rate. And that implied a negative risk premium. But people continued to pile money into property irrationally. And why was that? And they did it because they thought that rental growth would make up the difference. But what they also thought was that things would always be okay, that property would always increase in value and it would all come out right in the end. But it didn't. It didn't. But you could see that period where, as I said, despite everything, where apparently you've got a negative risk premium, people were still piling money into property. So I've had a look at the next slide, Martin, if I can. And that behavior reflects irrational exuberance. And that's a term that was described by Alan Greenspan, who was chair of the US Fed at the time. And he described it in December 1998. And he said that's when markets, and this was before the global financial crisis, that irrational exuberance is where markets bid up to an unusually high and unsustainable level under the influence of market psychology. And I'm going to come back to this, that in models of the market, and still this is still true, people do not make account of market psychology. There's a really good book by a guy, you may have come across him in other areas. It's not a property book, it's a general book on asset pricing by a guy called Schiller, Robert Schiller. And he does a really good examination of irrational exuberance within that book. So this is not original, and the ideas are not original that I'm talking about here. They're just original as applied to the property market, okay? But what I found interesting was there's this character, Charles Mackay, who was a Scottish journalist. He was working in London, but in 1841, he examined this and he wrote some stuff on South Sea bubble and various other bubbles. And he talks about the onion bubble in Amsterdam in the 1600s as well. Fascinating historical document. And he said, men, it has been well said, think in herds. They go mad in herds. Well, they only recover their senses slowly and one by one. And this is a classic. I mean, this is exactly what happened during, certainly in property, during that period of the global financial crisis, pure behavior. So we'll take the next slide, please, Martin. I'm getting there. So what I've said is that equilibrium theory assumes that actors in the market behave in a totally rational way. Now, let me just go to my notes. I've got a couple of things here. So finance theory assumes that the market is informationally efficient and that asset prices reflect fundamental value. So we've got this thing called efficient market hypothesis, and there are three forms. It's classic, always taught in economics, and we teach it now in property market work, where you've got three types of it, and it's according to the market information that's available. So you have a weak form where current prices reflect historical prices. You've got a semi-strong form where all information, that's public information, is compounded into prices. And you've got a strong form where all information, including information not public, is compounded into prices. And that's, you know, that's one area where it's classical economics. It assumes all sorts of things. It's based on equilibrium theory. And you've also got the capital asset pricing model, the CAPM in there, which examines a relationship between risk and return. And it postulates that the expressed return of an asset is a function of the expected return of the market as a whole. Now that's the classic approach to it. And again, you know, you think, it doesn't fit with reality. You know, it assumes that investors correctly process available information on a prospective cash flow and that they discount that through the DCF, a rate which is appropriate to available information on risk. And then you ask the question, that's the classic view, is it true that individuals do a good job at evaluating probabilities and making rational choices So let's have a look at the next slide and what I've done there. So are we good at judging probabilities? And there's a lot of good stuff, behavioral stuff on this aspect of market behavior. Yeah. And there's this thing called heuristics where it says like we use mental shortcuts, heuristics in our reasoning. And because of that, we arrive at biased conclusions that we don't properly assess the probability of outcomes. Okay. And what I've done is looked at, in the next slide, looked at 3 variants: representative thinking, availability, and anchoring. And I hope you begin to recognize this stuff, whether you've done economics or not. And it's a lifestyle thing. It's not just an economic thing. Can we take the next slide, Martin? I'm trying to dash through this fairly quickly. I'm looking at the time here.
Doing well.
Oh, look, we're okay for time, I think. I've got about.
You're doing well, Ed. Keep going.
Yeah. I know I'm speaking quickly. You're following me. So let's talk about representative thinking, and that's where we judge the probability of an event by its similarity to a pattern or template. And often we misjudge what the true pattern is, sometimes because of lack of data. And the kind of example of that is where you've got a really good company on the market, big company, record of profit growth, well covered by analysts and etc. And we say it's a good investment because that's the pattern. Yeah. Look at availability, where we judge the probability of an event by the ease with which we can recall similar events. Yeah. And we badly misjudge the likelihood of extreme events because we're continually referring back to somewhere else. Right. And I said, this is not just applied to economic theory, this is everyday life as well. And anchoring is where we make judgments and we tend to anchor on what first enters our mind, right? When we adjust from that anchor, as we review new information, we do adjust, but we frequently under-adjust. And when Stuart and I used to do forecasts in Scottish Widows, I was always conscious of this, that you're always referring back to old data and you're projecting forward on the basis of that. And you're making lots of assumptions that are not necessarily scientifically rigid. And it always worried me when we did forecasts in that regard. So all the implications of that are that investors will be reluctant to shift from previous decisions. In terms of portfolios, and especially with property portfolios, there's a home bias because you know it. And there's an overweighting in property portfolios of home countries. Yeah. And then we've got this thing where valuers produce sticky valuations and they're swayed by other irrelevant factors, where fund managers might be happy with a valuation which is not. And I've got to be careful because it's being recorded, where fund managers might go, oh yeah, well, it's not too far adrift from what I thought, right? And they may be swayed by their own decisions and how it fitted with their fund requirements. I'm not saying that happens all the time. I'll cover myself here, right? But you know, and you look at the risk management models that banks use, and they kind of woefully underestimate the savage effect of big shocks, like the global financial crisis, especially when everybody's trying to get out of the positions at the same time. So real problems. Now, I'm not saying that existing models are useless. All I'm saying is that when you use them, you have to be conscious of things other than simple economic utility, okay? So we move on to the next slide, Martin. Yeah. Now, anchoring, just going back to that anchoring, that it may cause, in part at least, it may cause overconfidence. People think they know the answer and they won't move much towards accepting other possibilities. People are overconfident in their predictive abilities, and I've seen that in property market forecasting. And they put very narrow confidence ranges on their estimates. The element of skill in what they do is often exaggerated, and the role of chance is denied, and they've got this illusion of control because of that. And confidence in judgment grows when it's confirmed by outcomes, but it's not weakened when it's contradicted. Okay, so you get biased attribution. And if you look at markets, what overconfidence results in is in excess trading, in the end, with lower overall returns in the market. So I think the next one is my final slide, I think. Oh no, one more. And I'm just referring back to regret and herd behavior. And it's this thing, well, okay, well, we can cover ourselves and we can avoid regret if it goes wrong by being passive. And we can minimize all of these impacts by following the lead of others, because we say, well, they did the same thing. And we're in that herd that Charles McIntosh was bloody, Charles, whatever he's, I've forgotten his name, was talking about. Is this herd behavior where you're safe in a herd, okay? And you do get that, this behavioral aspect, in, especially with regard to forecasting. And the final slide then says, it is important, behavior is important, and it needs to be taken into account into our models of the market. We need to qualify our economic forecasts and our property market forecasts. Models are imperfect because they don't take account of behavior, and very often the behavioral properties of economic models are terribly weak. But also you need to do it because of the interaction between investors and their valuers in particular, okay? So that's a bit of a rush through. We're just before 1 o'clock. I'm happy to take some questions, Martin, but I'm sorry it's a bit of a rush through there. But I hope I've given you a bit of a flavour as to where I'm going. And one thing I've started to do, and I'm just trying to get a paper published in a property journal, where I've using systems dynamic modelling, which can take account of behaviour, to model rental value growth and rental behavior in markets. And I think it's that way forward. We have to start looking at those kinds of models, not the pure econometric models, if we're going to move this any way forward. So there we are. I've just looked at myself on the main screen, and I recognise that lockdown haircut. So, so there we are. I'll take questions.
Very well done, if I may say so, because I know we squeezed your presentation, but you made some excellent points. Peter's going to chair this a little bit. So if you want to ask a question, wave at Peter, and then he'll introduce you to ask your question. Please do. It would be great to reinforce some of those points with questions and answers. So just over to Peter to chair this part, and then I'll finish off in a few minutes. Peter.
Martin, you might be able to help me here, because I can't see everyone on the screen. But
right, in that case,
I've got one quick question, if I may.
Yes, you go ahead, Peter.
So, Ed, thanks for that. I'm particularly interested in the rental market and how traditionally the UK has been a place where people feel they have to buy and own a home, whereas perhaps more on the continent in Europe, there's a sense of renting is the way to go. Do you see there being a change now we're out of Brexit towards that?
Well, yeah, what I didn't include in that CV was that I chaired for 3 years, I chaired a Scottish Government committee on the residential market and build to rent. And one of the good things about Scotland is that it really strengthened the laws with regard to sort of tenant-landlord associate relationship. And I believe that if it's done rightly, because of what the Scottish Government have done, that yes, in terms of residential, we should move towards much more towards rental markets, good rental markets. Yeah, because Margaret Thatcher kind of, hang on, we're getting all sorts of funny things on the screen, so I don't know what that is. I'll cancel this. Hang on a minute. Let me just cancel this. Yeah, and I think there's a much stronger case for rental in the UK, in the residential markets. In Germany, 60% of properties, 65% of property is rented. In France, it's something like nearly 70%. and they haven't got this fixation with buying homes. And with the current protection, yeah, I think rental markets and renting residential property is a much better bet.
Yeah, thank you. Back to Martin.
Okay. Anyone like to ask a question? Just give me a wave. I can see all the faces other than Mike and Isabel. Ben's next. Ben, please go ahead.
Yes, how much I enjoyed that presentation. Ed, the dissonance theory in psychology indicates that someone buys a Vauxhall car, let's example, and then they'll use that decision later on when buying another car.
Yeah.
Because if they choose something else, it implies that the first decision was wrong. And I wonder that applies just as much as anchoring in your
Oh, that
thesis.
is anchoring. That's classic.
Yeah,
Anchoring.
yeah.
Yeah.
So there was a lot of resonance in what you were saying with my background. So
And
thank you very much.
That's what I was trying to say. It's not just about markets, this. I came into it through markets and the property market. But in just ordinary life, you see it happening all of the time.
Well, maybe the whole process for most people is kind of like que sera, sera, you know, but throw it up in the air and see what happens.
Yeah.
And there's where the irrational thinking comes in.
Yeah.
Thank you, Ben. Any other questions, please? Just give me a wave. I'm thinking of perhaps Christine or Lorna. You very kindly joined us. Anne, anybody want a question there? I'll give you oh, yep, here we are. John Dunbar's come up with a question. John.
I was just thinking about supply and demand. If the population, for some reason, dropped dramatically, would house property prices come down in accordance with that?
Well, they do eventually, but the stuff that I'm doing now, this systems modeling, is as much about the things that drive market prices to equilibrium, like you say, as about how much they drive things away from equilibrium. And that view of the market is that the market never comes to equilibrium. It's always changing, yeah? And that's what I was trying to say about maximizing utility. In classic theories, you're right, what would happen? You've got a supply-demand curve, and you would expect these forces to come together to that utility curve. There's a couple of things, you know, property market is not cans of beans. You can see that if you're selling cans of beans, they would very quickly come to some sort of equilibrium. Yeah, property is not like that. It takes ages for things to come to equilibrium. And my view of residential markets is that it's much more about behavior and perception. And that bit of the curve where you're packing money into property with no real scientific basis, which drives prices in a certain direction, and they don't necessarily drive the market to equilibrium. They're pushing it away from equilibrium all of the time. Does that answer your question, John?
Yes, sort of.
Yeah.
Thank you, Ed. Not easy. Lorna, did I see Anne gave me a wave? Sorry, Anne was definitely next. And then Lorna, did you want to ask a question afterwards? No. Okay, over to Anne, please. Ask your question.
This is a bit of a tangent, so feel free not to spend time on it if there are more relevant questions. But having been a banker 25 years ago and glad to have got out of that when I did, given what subsequently happened, and in subsequent years worked in church ministry and in chaplaincy, I wonder, having given us a very helpful insight into how people behave, whether you can offer any suggestions of practical things that we can do to help shift mindset and therefore shift behavior to be more responsible.
Well, yeah, I think that's what I was trying to get at when I was talking about economic models that don't rely on classic economic theory because it doesn't represent reality. And that what we need to start doing, and I can only say in the property field, what we need to start doing is to building in these behavioral aspects into modeling, where we can start to look. I mean, what are the consequences of bidding up on properties? You know, Stuart and I and Colin Jones went down to the Bank of England. I can't remember when it was, Stuart, you tell me, but it was about 2 years ago, I think, after we'd done the book on property boom, banking bust. And what they've started to do at the Bank of England, they've started to recognise this stuff, and they produce a quarterly report now on fair value. It's got to be driven by some sort of independent organisation like the Bank of England, right? And what they want to do is to come to some sort of conclusion about what fair value is at any one particular time, given the forces in the market. And what they said they can't do is to interfere with the market, right, at a supply demand level. But what they can do is to put some controls on loans and the value of loans and the loan to value, the loan to value relationship. They can influence that. And so they're beginning to look in terms of that aspect, fair value in the market, and how they should shift their policy with regard to loans.
Mhm.
So, on the macro level, does that answer your question? I mean, I think that's a very good way of doing it. They've not got there yet, but it's always interesting going into Bank of England and Treasury sites and having a look at that fair value report that they do as part of a much wider thing. They don't just do it for property. Oh, Stuart, you were there.
Thank
So does that answer the question? Sorry.
Thank you for the question, Anne, and thank you, Ed. I'll take one more question because we need to respect people's lunchtime break. Stuart will ask the final question, please.
Thank you, Martin. Thanks, Ed. Good presentation. I would maybe like to put some defence on the part of fund managers, and I'm wondering, do regulations force investors to act irrationally?
I'm not sure about that one, Stuart. And I think you're probably right. They some sort of regulation at the fund level. I mean, we've got Basel III, and we've got those kind of regulations in terms of capital and capital commitment. And I just wonder whether it needs to be taken down to the next level. So you're applying those kind of rules at the fund level, yeah. And I think you're right. The lack of regulation drives things in this direction, in my opinion.
All right. Well, look, I think we'll finish it there. If you may allow me to, Ed, just to say on everyone's behalf, a thank you to you for telling us about irrational markets. I think the fascinating part, of course, is when you made your comments. I know some of them so-called off the record, so to speak, is the irrational behavior of people. But I think you offer us some very wise words and example there about the dangers of property markets overcooking at times. And of course, we have a history of that in this country. So you've certainly imparted some excellent knowledge based on your experience. We thank you for that. Whether we are wiser, I guess only time will tell. But I do thank you on everyone's behalf. Normally, of course, we were all meeting face to face at St. Cuthbert's or wherever. We would give you a round of applause. I'm not sure we can do that on. So we'll do it at the very end. But yes, perhaps that's a nice way of doing it.
Thank you.
So we really do thank you, Ed. And if I could just take 2 minutes of everyone's time just to say the reason we get together like this. There's been a history of organizations like Business Matters, OASIS, Chaplaincy, Workplace Chaplaincy in Scotland, the Arts Chaplain, and so on, just trying to connect with the business community to say, we, the local churches, were there. We know the business world is under immense pressure, particularly now with either redundancies or the threat of redundancies or job insecurity, plus, of course, pressures at home associated with the lockdown and so on. So it's simply a case that if anyone wishes to have a private, confidential chat with a listening ear, we don't offer advice, but we just offer you a neutral person to speak to. We have a group of people in the chaplaincy service and some very experienced people, several of whom are actually on this call who've been through redundancies themselves and so on, well, offering a listening ear to anybody in your particular workplace where we could possibly help. So do bear that in mind. You know how to get hold of us because you came on this Zoom call, and my email contacts details are at the bottom there, along with my phone number. So thank you all ever so much for joining us today. Really very grateful to you. And I'll just leave the very last word to Peter, if Peter comes under mute. But again, my personal thanks to you, Ed.
Thank you.
And my personal thanks to all of you for joining us for this relaunch, and particularly to Martin, because we've turned around the relaunch of OASIS incredibly proficiently during lockdown. And Martin, when's the next talk? Have we got?
We'll always meet on the last Thursday of each month. Our next speaker is Leighton, which is in the middle of my screen towards the top there. He runs his own business. So I've asked him to speak about some of the pressures associated with small, medium enterprises and the stress level. In some ways, even when I worked for a very big company, I ran a business group within a big company. And so some of the pressures that Leighton will be speaking about will be mentioned. So that's the very last Thursday of February, which I think is the 25th, but mine's just gone a blank on that. 25th says, yeah, Leighton. So please do join us then. And it is open to anybody who would like to join us. And thank you very much indeed. Thank you,
well, thank you. And everyone, take care, stay well, and God bless. And hopefully see you at the next meeting, or if not before.
Okay.
Bye.
Thank you.
Everybody.
Bye. Bye.
And thank you very much, Ed.
Bye.